Hey guys, what's up? I'm Erin and welcome back to the channel. What's your ideal retirement age? What's the number that comes to mind? I bet you have a number because I think we all do. But recently, a troublesome statistic came out of a survey from F&G Annuity and Life of 50 to 60-year-olds. 71% of people in this age bracket, aged 50 to 60, have already or are considering delaying their retirement date. That's an alarmingly high statistic because this is really the age group that's on the brink of retirement, or at the very least, on the brink of having a solid retirement date in mind. If you're in your 50s, that's kind of the time when you should be solidifying what your retirement plan looks like. But the fact that over 70% of the people in this age bracket are considering delaying their retirement date or have already delayed their retirement date, that should cause us a moment of pause. That should cause us to ask, what's going on? Why are so many people having to delay their retirement date? And according to the survey, there are three main reasons people are feeling like they're being forced to push back their retirement date. And my thought is that if we know what these three reasons are, that we can better equip ourselves to retire on time exactly as planned. However, it is worth keeping in mind that many of us don't get to choose their retirement date. It's nice to have an age in mind when you plan to step away from the workforce, and I hope everything falls into place and goes exactly according to your plan. But we should acknowledge that many of us might be forced into an early retirement. That simply could be because of a medical event, having to take care of a family member, maybe company downsizing. Whatever the reason may be, the fact of the matter is that 56% of Americans say they were forced to retire earlier than expected. So I think the best attitude is to plan and prepare the best you can, because hopefully everything goes according to plan and we get to retire at the age we choose, but many of us may be forced to retire earlier, or maybe we do have that flexibility and we can push our retirement date back if we want, but there are a lot of unknowns that go into this. So what are these main concerns that are having current, soon-to-be retirees pushing back their retirement date? And how can you prepare for them so they aren't a concern for you? The biggest concern among this age bracket is simply not having enough money for retirement. In fact, 49% of people surveyed said they worried about not having enough money for retirement. Now, digging into the details of this survey, we see that they only pulled respondents who had a minimum of at least $100,000 in investable assets. According to the Federal Reserve, the median retirement savings of those 55 to 64 is about $185,000, with the average coming in much higher, coming in at over $500,000. There's always going to be a big disparity between the median and the average because those with incredibly high balances tend to pull that average up. But for those in this age bracket, 50 on up, I think this is really the time when you're in the home stretch for retirement planning. And this can be really the time when people look at their account balances and say, oh gosh, I don't know if that's enough to last me for, say, a 30-year retirement. Especially if you're near that baseline threshold of $100,000 invested at this age, or maybe you're even closer to the median with $185,000 in investments. You might look at those balances and say, this is not enough to provide the life that I want in retirement. Unless, of course, say you have a very reliable pension and you combine that with Social Security and you're looking at a very reliable income stream, maybe at that point the amount you have invested really isn't a top concern for you. However, the vast majority of retirees do not have a pension, so their investments really are the bulk of what is going to carry them through their retirement years. So if you're in this age bracket and you're looking at your accounts and they just don't feel like they're where they need to be, first step is to create a solid plan. Log on to the ssa.gov website, figure out what your Social Security check is going to look like, figure out what kind of gap you need to fill. The more information you have, the better. Let's say you have the median account balance, that $185,000, and you and your spouse are 50 years old with the goal of retiring at 65. But right now you're feeling a little bit behind and you can't really fathom how you're going to get there. The Securities and Exchange Commission actually has a really awesome calculator that can help you figure out how much you would need to save each month in order to hit your goal. So let's say that you have a goal of retiring with $500,000 in household investments. Simply type in your goal and it will tell you how much you should save each month to hit that benchmark. In this example, we see that this household would need to put away $266 a month to reach that benchmark. I feel like that's rather encouraging. That's an amount that seems pretty doable. And I think it's important to keep in mind that if you still have 10 years or if you still have 15 years, that's still a long time horizon. You can make a lot of headway in that time. Now, in this example, let's say this married couple is each anticipating about $1,500 a month from Social Security. And if they have a household net worth of $500,000 at retirement using the 4% rule, they would be able to withdraw $20,000 a year. And this could give them a household retirement income of $56,000 a year. Maybe this couple could even save more during this time. Maybe at this point they have children, but maybe those children are grown and out of the house and supporting themselves. Maybe at this point they could even pay off their home in full, and that way they would have a lower debt burden. They could go into retirement with a completely paid off home. I really love the idea of going into retirement completely debt-free. I think it takes a huge burden off your shoulders going into retirement with a completely paid off home. Reducing your debt burden, reducing your expenses, reduces the overall investments that you need. The next biggest concern for soon-to-be retirees is the impact of inflation, with 47% of people saying they're delaying their retirement date because of inflation concerns. And there's no doubt about it, inflation is a real concern. Slowly but surely, it reduces the purchasing power of our dollars. And once you've stepped away from the workforce and are no longer earning a paycheck and are simply relying on what you have investments, this can add another layer of stress, knowing that your dollars are worth less over time. Consider that $50,000 in 1994, 30 years ago, would be the equivalent of roughly $106,000 today in 2024. Using that same $50,000 in 1994, you would need to have nearly $63,000 just 10 years later by 2004 to have the same level of purchasing power. After 20 years' time, in 2014, you would need roughly $80,000. Looking at these numbers and seeing that over a 30-year time horizon, you effectively need double the dollars in order to maintain your standard of living and maintain your purchasing power, it's really easy to see why inflation is such a concern. The wonderful news about Social Security is that it is indexed for inflation, so it does increase slowly over time. And if you're using a safe rate of withdrawal, something like the 4%, those rules also allow you to increase your annual adjustment by the amount of inflation. Let's consider these facts about the rule of 4%. According to the Trinity study, the 4% rule has a 98% success rate over a 30-year period. According to William Bengen, the founder of the 4% rule, 90% of retirees who follow the 4% rule and increase their annual adjustment by the rate of inflation, 30 years later, 30 years into retirement, their portfolio actually has more in it on a nominal basis than they started retirement with. Even more impressively, 70% of retirees who follow the 4% rule ended up with double their starting portfolio value in 30 years' time. And 50% of the time, retirees ended up with more than 4 times the value of their initial portfolio during a 30-year time period. Those are wonderfully favorable statistics stating that if you follow a safe rate of withdrawal, your portfolio should be more than robust enough to handle your inflationary concerns. Next up, 31% of people in this age bracket cite wanting to delay their retirement age based on concerns of a recession or a stock market downturn. And these concerns aren't unfounded. This is really speaking to sequence of return risk. Sequence of return risk is the idea that the order and timing of investment returns can have a negative impact on your portfolio, especially if those negative returns happen in the first few years of retirement. Now, as I said, sequence of return risk is a huge factor to consider. Consider this example of 2 different investors who both start out retirement with $1 million portfolio. In this table, the average annual rate of return is identical at 6%. The rate of returns are actually identical, just flip-flopped. Mr. Green starts out with positive years and Mr. Red starts out with negative years. As you can see, starting out with a few very negative years just at the start of your retirement makes it so that Mr. Red's portfolio ultimately fails and he's unable to make his withdrawals. And running out of money in retirement is definitely a problem we want to avoid at all costs. But what if you made just one tweak? What if Mr. Red didn't start making withdrawals from his portfolio at the age of 65? Yes, he still retired at that time, but instead he left his money invested until the market started to turn around. He didn't start taking his first withdrawals from his portfolio until the age of 69. What would happen then? Just look at what happens to his portfolio over time. Yes, the sequence of returns still played a huge factor. Mr. Green still has a much larger portfolio by the age of 90. But the key important thing to keep in mind here is that Mr. Red's portfolio didn't fail. He was able to successfully make his annual $50,000 withdrawal. Now, asking someone to hold off on making withdrawals from their portfolio for a handful of years may or may not be realistic, but it could be realistic if you go into retirement with a very large cash buffer. That is to say, you have a couple years worth of savings set aside in a cash-like account. Maybe that's a high-yield savings account, laddered CDs, somewhere where this money is earning some interest, but it's stable and not subject to wild fluctuations. And that can safeguard you from being vulnerable to sequence of return risk. You're not forced to make withdrawals from your account in those years when it's down, especially in those early years when those negative years are more impactful. You can be patient and let that money the time it needs to recover. This is where something like the bucket strategy in retirement as a withdrawal strategy can really come in handy. It might also be helpful to know that back-to-back down years with the stock market are incredibly rare, and having 3 back-to-back down years has only happened 3 times in the past 100 years. So it's not to say it's unheard of, but it's unlikely. What are your biggest concerns when it comes to retirement? And do you have a plan to combat these concerns so you can retire as expected? Or if you're near retirement age, are you planning on moving your retirement age a little bit further into the future? Let me know your thoughts in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing. Or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. There's a construction vehicle, and if that's the case, I'm going to cry. Softer, just soft. Think soft. Soft thoughts. Moment of pause. It should cause us to ask, oh, that's my front door. I just don't think that's possible. Now, digging into the details. Speaking of digging, they are digging holes in the lot next to me, and I cannot do this. They are so loud. Is that, calm down, calm down, calm down. Okay, Chorizo feeds. Okay, this is the worst filming day ever. Oh my God. Period. That was annoying. According, that's also annoying. Out of retirement and running out of retirement. I don't think you run out of retirement unless you're dead. That's running out of retirement. Now the birds are out. This is a day for me